Tell me about the whole SALT, because I do know that did hurt a lot of blue states or high tax states. On the itemized deduction, it was only capped at $10,000, but now it's no longer. Now they expanded that, so now it's almost like contradictory. Now the itemized deduction might come back into play because of some of the changes to SALT.
That's a really good question, but it has some restrictions as well. They introduced a temporary increased SALT deduction of $40,000, and it is applied to single filers, and the same $40,000 applied to married couples filing jointly. And if married couple files separately, then the deduction is $20,000. However, the income plays a role in how much you can actually deduct. If the household income exceeds $500,000, then a reduction of 30% will be applied that goes beyond $500,000. So that $40,000 deduction phases out when your adjusted gross income goes beyond $500,000. For example, if we have a household with adjusted gross income of $550,000, so what we do, $50,000 is above $500,000 threshold. We apply 30%, and that is a $15,000 reduction. So $15,000 we subtract from $40,000, and that household can actually deduct $25,000 instead of $40,000. However, if the income gets, let's say, to $1 million, right? So then that reduction would be even more than the actual deduction, but the deduction cannot go below $10,000. So if we have like high earners and they do make more than $500,000, their deduction cannot go like below $10,000. So it really depends. So let's say their SALT tax is $50,000, but it depends on their income. If they make pretty good amount, then they might actually get the old amount, $10,000.
So this is interesting. So then the state and local taxes, the first thing that popped in my mind was real estate taxes, but does it include income taxes too?
Yes.
Okay. So it's interesting because, as mentioned, the initial Tax Act in 2017 was trying to push people more towards the standard deduction. But now with SALT, especially if you're earning less than $500,000, if that cap is now 40, and you're living in a high tax state, I mean, you might now be back to the itemized deduction land.
Exactly. So that's a great planning opportunity for those households. For example, they are on the verge of $500,000 income, and the threshold is on AGI, adjusted gross income, right? So how do we arrive at AGI? We take the overall income, the gross income, and then we apply some deductions such as retirement contributions, alimony if before 2020, HSA contributions, then self-employment tax. If an individual is self-employed and they pay for their insurance, that's something they can deduct as well, and they are called above the line deductions. So then we arrive to the AGI income, right? So it will be very beneficial for those individuals that are on like verge to surpass that threshold, $500,000, to max out their retirement contributions to reduce that income so they can utilize the full $40,000 deduction.